Hello, I'm Kimberley Dondo, Digital Content Manager, and welcome to In Conversation With, the podcast series that delves into the world of financial services and brings you face to face with some of the most notable figures in the industry. Listen as we discuss topics that are currently facing the industry and hear from visionary CEOs to disruptive innovators as we bring you a diverse array of voices and perspectives. We'll explore the challenges they faced, the lessons they've learned, and the insights they have to share about the ever-evolving landscape of financial services. Hello and welcome to In Conversation With. I'm Kimberley Dondo, and in today's episode, I'm joined by Paula Steele, Director at John Lamb Hill Oldridge. Thank you for joining me today, Paula.
I'm absolutely delighted to be here, Kimberley.
So could you give us a bit of a background into yourself and how you got started in financial services?
Okay, I've worked for the business that's now called John Lamb Hill Oldridge for 45 years. So I've been here a while.
A veteran.
A veteran. I actually got the job originally from pure nepotism in that, a nepo, in that my father did a lot of work. He ran an offshore insurance company. And I have a long-standing history in insurance in consequence. And he had a mate called John Lamb who said, I need a junior. And that's how I came to work for the business. Before that, I was an actuarial trainee for an insurance company. So I did have a sort of technical background, and I came to work for John as a power planner.
Wow.
Part of the buyout team that bought him out in 1984. And I've been here ever since. So it's quite a long time.
Wow, that's amazing. So getting into the topic of today's podcast, I wanted to know, what are the main aspects of protection financial advisors focus on, whether it's safeguarding estates, protecting families, or securing companies?
I believe passionately that all financial planning should be based on family protection. That's where you should start for all planning. If there's a disaster, whether that's death or ill health, which are the two disasters that the insurance industry can help with, then I think that as advisors, we should be advising clients about that, and we should be really quite focused on it and getting the clients to think about what would happen what's the impact of death or ill health. In fact, most of our business is actually covering inheritance tax liabilities, so estate protection. But certainly when I started, the key to what we were doing was you always did the family protection bit first, and then you moved on to doing investment work or whatever. And I think that's very important, because that's really what the insurance industry is all about.
Yeah, definitely. And it's probably an aspect where some clients might not want to think about. They want to think they'll live forever or something, or their families will be absolutely fine.
I've only once had a client who told me he was not going to die. He just said, I'm not going to die. And so it was, I think then it's very difficult, but it's difficult. People don't want to talk about death. They don't. And I believe that you need to say to clients, what's the impact of you dying? What income are they going to have? What capital are they going to have? What is the impact? Are they going to have to move schools? Are they going to have to move house? And there's not really enough focus on that. A lot of that, particularly for the young, where cover is so inexpensive, there's not really enough in terms of earnings for everybody to do the job properly. That's
definitely.
So, yeah.
And how do advisors tailor protection plans to fit their clients' needs and risks?
Okay, it's all about identifying what the need is. So this is the need. If as a family, somebody had died last night, you need to pay off the mortgage. So you need to tailor the cover that will pay off the mortgage. If it's a repayment mortgage, you cover it with mortgage protection. And then you need to say, and how much income do you need? If people are currently living on, I don't know, 60,000 a year, and actually somebody's going to have 10,000 a year, you need to say, well, how are they going to make up the gap? Now, they won't have a mortgage if you've paid that off, so maybe that's costing you 20,000, but you've still got 30,000 gap, and they're telling me that they can't afford to save anything. And you need to just say you can buy family income benefits, which is very cheap cover, and we'll give you the £30,000 shortfall. But you need to do the work as an advisor to have identified the shortfall. Similarly, if there's income protection, if you can't work because you are ill, and then you need to help clients in terms of some statistics. You've got this chance of being unable to work for more than 6 months compared with dying, and all those statistics. And the clients will then, they might not buy as much cover as they should, but they will then focus. And they think often that they've got cover through their employer for income protection. Often, actually, the cover only lasts for 2 years or 5 years. It doesn't cover the term. The market is moving to a much longer deferred period to reflect that. So you used to only be able to buy, 4 weeks or 13 weeks or 6 months or 52 weeks. But now I think you can actually buy 2-year or 5-year deferred. So it will cover it if your employer, because the risk is your long-term ill health. And we've done far more claims for ill health than we have for death. We sell far more life cover than we do income protection. But we do many more claims for income protection. People who've got back problems, people who have nervous breakdowns. I had 2 clients, one of whom had a back problem and was in the building trade. It was a woman in the building trade. And she was earning 120 grand, and she can't even wheel a trolley at a supermarket. Her back's so bad. She certainly can't be on a building site. And the insurers have paid, so that was good. And if you're doing inheritance tax planning, you need to say, how much tax are you going to have to pay? And is it going to be paid on the first death, the second death, if you've got a couple? And then you're going to say, this is how you are going to look at what is the need, what's the impact, where are you going to fund the inheritance tax from? Now, if you've got lots of liquidity, it's fine. But most people have a lot of property and there is no liquidity. And therefore, you need to say, you are going to have this liability. And if you've got this liability, you can self-insure it, or you buy. And if you're buying protection for businesses, which is the most underinsured part of the market, then I think you need to be saying, what happens if you die? Who have you got to get in to replace you? How are you going to deal with the shares? And if you start to challenge the clients about that, they will then basically come back and say, yes, I do think I've got a need. And once they've got a need and they understand they've got a need, then they buy insurance.
Yeah, I mean, if they aren't unaware, I guess they wouldn't think about it. But once you give them all the examples, I think you show them why it's necessary for them and their families. So do you have any other examples of how effective protection planning made a significant difference? You talked about the woman who worked in building, and she had back problems, and that would be a huge hit for her if she when she wasn't able to work, right? So are there any other examples you have?
In terms of in terms of a death claim, we did actually have one which somebody we were asked to put together something. A couple got divorced, and he had to pay her 50,000 a year until the children were 18. So that I don't know how long it was, 15 years, I think. And they covered that. so that the 50,000 a year would be paid for the balance of the 15 years that it needed to be paid. And actually, he was stung by a bee 3 months later and died. He had a massive anaphylactic shock, and died. And so we've been paying out that 50,000 index linked, and it stays indexed in payment. And it's tax free. It's a great deal for her. It's actually, and he would have, although he objected to buying the cover at the time, said that. I had somebody where the lawyers are asking him to do something similar last week, and he said, I'm not buying the insurance because if she's got insurance on me, she'll buy a hitman and kill
Oh my God.
I said, which is what's called divorce paranoia, I think.
Yes, yes. I mean, you do hear those true crime stories of people taking out, insurance policies, and then mysteriously a few months later something happens to that person. But I'd like to think those are very rare because it's probably quite easy to trace back what might have happened.
Well, I just don't think that. And in our business here, so much of it's inheritance tax. I had one the other day, and it was a huge case. It was 11 million, and the life insured died. It was interesting. The solicitor came back because we'd settled the 11 million, and the solicitor came back and said, because we've got the 11 million, we can hold the estate intact. Without it, we would have had to sell the whole estate, which has been in the family for generations.
Wow.
And she said it really brought it home to me just how important it is, because she said we could settle all of the tax. We're not having to settle it over 10 years. A lot of what we do, people don't want to buy the insurance for the full amount of the cover. They don't want to afford it. So they'll only cover 3 or 4 years because the tax on property can be paid over 10. In fact, and they'll cover 3 or 4 years so that they've got time to make the sales, because they're saying, I won't buy 10 years of full cover. I don't want to afford it. And I think where you've got clients, everybody has affordability issues. And you need to be saying to them, okay, if we can't cover it, do we want to bring the cover back and cover just part of it? Or do we want to bring the term back and therefore cover all of it, but for a shorter period of time, and worry about it in the future? You put the problem out, but at least we're covered for the moment. We have quite a lot of clients. I'm a great believer in family income benefit, because that gives a spouse who is widowed or a widower, that gives them tax-free capital that's going to come in while they need it, while the kids, so keeps the kids in school, keeps the house, pay off the mortgage, and everybody can then, they've got time to recover and know what they're going to do. So yeah, I'm a great believer in family income benefit because it's so cheap. When my daughter got married, or was married and had 4 children, and my son-in-law said, I want to buy £1 million worth of life insurance, so that whatever, and was very upset when I said to him, yeah, well, you can buy, rather than buying £1 million, you can buy 100,000 a year for 20 years, which is 2 million of cover. But it runs off over time. And he was less keen on that, because he felt that he wanted to have the £1 million. I wanted her to have 100,000 a year to cover the mortgage and the children and all of the rest of it until they were on hands. And they say I pulled rank. Mother-in-law pulled rank.
I mean, to me, it makes sense, though, the longer term planning. But maybe that's just a different perspective of mine's.
I think men are very funny about whatever, in terms of if people say, is there a difference between planning for men and women? Not really, but there's very difference in terms of what people's drivers are. A lot of men will say, if I give her £1 million, she'll go off and marry somebody else and it's whatever. But if I give her 100,000 a year, then they're more comfortable about that. Well, God have the £1 million. Well, because her life will need to move on.
Yeah, of course.
Well, it's still typically on that sort of basis. It could be the other way round, but if the husband thinks that he will sort of continue on in some way from the grave, while she will need to move on and the family to move on. But there's very much a difference of opinion about from the person who's paying, who wants to tie it all up so that it's with control, and the person who is receiving, who definitely just would like a big lump sum.
Yeah.
So you have to resolve that with the couple.
And I think you touched on this a little bit, but how do advisors strategically use life insurance for tax planning?
Our experience is entirely in the inheritance tax. I'm not sure that for income tax and capital gains tax planning you're using it. Strategic for inheritance tax planning, you're identifying what the liability is. So you've got an estate and you've got £1 million liability, £2.5 million of chargeable estate, £1 million. So it's a lot at whatever. And then you've got to say, you're going to have to pay this tax. Where are you going to find it from? Now, if 2 million of it is tied up in a house, everybody may be happy to sell the house.
Yeah.
But if somebody wants to inherit the house, then you're going to have to find an alternative way to cover it. So strategically, it's about saying, what do you want to happen to the estate? Yeah, clients will say, oh yeah, I just need to cover the inheritance tax. We do a lot in looking after some quite big estates, big landed estates out of London, but also some London property estates. And for them, strategically, if somebody dies, for them to unwind the estate enough, because you've got to pay the probate within 6 months of the death.
Yeah.
And even if you're going to say that you're going to defer it over 10 years, they've still got to pay 4% of the capital value, and they don't have that. So they've got to think, what will happen if? What if? What are we going to sell? How long is it going to take us to do it? So it's really a question of working with the clients to say, well, how's it going to work? And sometimes the clients will say, I want Jemima to have the house and I want them to have the liquid. And you say, but if you're going to deal with it like that, all the liquid is going to pay the tax. And if Jemima's to have the house and she's got to pay the tax on it, then has she got enough cash to pay the tax?
Right.
And if people are doing gifting, particularly where people are gifting, you have a 7-year tail on a gift. You can make unlimited gifts to other people, but you've got a 7-year potential tail in terms of tax. And you can buy cover, and that tail of tax is 40% for 3 years, and then it runs off over 4 years. And if you say to people, you've got a potential problem here, what happens if you've made a gift and they've spent it? They don't spend it in terms of going to the races. What they do is they pay off their mortgages, put the money into their pension, they put the grandchildren typically onto the property ladder, and there's no liquidity left. We always say it's all about liquidity management, because that's what people need. People need liquidity.
Yeah.
So that's what we're helping them to do. And that's what the insurance industry can help people to do. Give you the cash that you need when you need it. When you're dead, because you've got to pay the tax.
Yes.
When you're dead because the family have got to be protected. When you're ill because you haven't got an income coming in.
And how does life insurance compare to other tax planning tools?
Cheap, simple.
Sounds like a no-brainer.
The most effective, well, if you're doing in terms of family protection, if you haven't got other assets, it's pretty well your only option. You're either going to leave the family completely unprotected, or you're going to buy insurance, because you haven't. You can say, oh well, my parents would support the spouse. Not sure the spouse wants to.
It's
Yeah,
tricky.
well, tricky. I think that's tricky.
Yeah.
So if you don't want that to happen, then you've got a liquidity issue, and you haven't really got many alternative options. Because people, if people have got young families, the cost of the family plus the cost of the mortgage, everybody has a mortgage, means they haven't really got an awful lot of money that's spare. Very few people have a lot of spare money to build up capital value. They're paying the mortgage, they're going on holiday, they're getting the kids through school, whether they're paying for private education or whether they've got them in the state system, it still costs. And our experience is that people don't really have any ability to save at that point. So your only option is insurance. When you get to, as you've moved into the second age and you start to save and you are perhaps at the peak of your earning power, at that point, then the most efficient way to do inheritance tax planning is to give it away. But you may not want to give it away because the children are too young, or you don't like who your children have married. That's the main reason that people don't give it away.
That's fair.
Or it's just too early. So, and they haven't got enough assets to be able to give it away. That's the other thing. You need to make, I always say to clients, you're my clients. We need to make sure that you've got enough money that whatever happens, you're going to be okay, and that we can deal with care if that's needed. Because that's the biggest reason that people find planning when they get to their 60s and 70s, which is when most people do most of their planning, really. The most difficult part of it is, how are we going to deal with care? How much is care going to cost? And what do we have to keep back to make sure that we can deal with the care costs? So you're going to have to deal with that and them. And then if there are surplus assets, you can say to them, well, perhaps you can give it away. That's the most effective thing, because you've got a 7-year tail and that's the end of it. But everybody's going to end up with assets they're going to own. They may have assets with huge capital gains tax, but that gives them a problem as well. Because they've got to, now 24%, it was 28% of its property assets, because that was going to trigger a capital gain. So often it's better just to hang on to the asset, and people like to have the assets. And I think there's a huge difference in terms of planning for people who've inherited wealth and people who've made wealth. People who've made wealth don't really care about inheritance tax planning. They will say to you, a lot of them will say to you, I started with nothing. And if they get 60% of it, they're jolly lucky. They change a bit when they get grandchildren. They're very tough with their children and spoil their grandchildren.
Typical.
But it's very different if people have inherited wealth, because even in one generation, it becomes a custodial relationship. So if you're talking about assets that you've inherited, for a lot of people, they feel they should pass those assets on to the next generation. So for them, it's a very different type of planning. The people who made a lot of money often won't do any inheritance tax planning, and they won't give it away. If you work quite hard to get it, you might be keen on giving it away.
I mean, I guess I understand the psychology of that a little bit, but it's interesting. I also wondered if any recent tax law changes might have impacted the use of life insurance for tax planning?
Um, yes. um, the changes to the non-dom rules, moving from a domicile to a residency arrangement, for which we don't even have a consultation paper yet, so it's not quite clear what's going to happen in terms of that. The headlines are that people who are currently UK resident, if you are a resident here for 10 years, that you are going to have to pay inheritance tax on your worldwide assets. At the moment, it's 15 years. But when you leave at the moment, you can get rid of the tail if you are non-dom. 3 years. It's going to be 10 years. So it will be very much an issue at that point of saying, as far as the clients are concerned, we need to look at what's the impact, when is the tax going to trigger, and do you need to do something about it? Because insurance, particularly on short-term covers, is very, very cheap.
Yeah.
If you just need 10-year cover and you're 60, it's going to cost almost nothing. And therefore, it's a very good deal to do it like that.
Okay. And finally, I wanted to know what future trends you anticipate for the role of life insurance in tax planning.
Lots.
Yeah.
I'm not sure that it's going to be. I think it's the role is it's in terms of tax planning. Insurance is dealt with through a different part of the regulatory environment. It's an ICOB product, not a COB product. Most of the people who are, if you look at the IFA sector, most of them are doing less and less life insurance. It doesn't fit with their views about consumer duty. It's still a product that has to be sold. It's not a product that is bought. It still pays commission. Doesn't work within a wealth management environment. So we're seeing, we get lots of inquiries that come into us, and in the past they would have been dealt with by somebody who was an IFA, but the IFA become a wealth manager, and because they've become a wealth manager, they're not so interested in dealing with the protection for inheritance tax planning. And even on the investment, wealth management for younger clients, they don't tend to have a look at it. Placing cover in the market at the moment is really quite difficult. Post-COVID, insurers we have endless medical issues. We're specialists. And we have a team that do nothing else except place cover, but that becomes very difficult within a wealth management environment. And I think that you're going to see less and less of that. More and more of cover is bought direct. So you go to somewhere like Money Supermarket, you'll turn up at somewhere like Reassured, who actually deal with Money Supermarkets, actual inquiries, and they're very efficient. But you're going to say, I want to buy £100,000 of cover. I want to buy £500,000 worth of cover. And it will be very much driven like that. And people very much underinsure if there's no real advice going on. I think they do a fantastic job at Reassured, but it's placing a huge amount of cover, a huge number of policies, and they haven't got time within that environment to say, well, maybe you need more. Let's talk. Yeah. They're very efficient at it. I think it's a great business, but it's that whole thing where people have been given advice, and that whole basis that you start by doing the protection work, people are not really being trained to do that anymore.
Mm-hmm.
That's how I was trained. I was trained the first thing you do are the disaster scenarios. You
Right.
die, you're ill, and then your tax, and then you talk about investments. But now I think they talk about investments. They don't. I'm seeing very little of that basic protection work being done.
Mm. Well, I hope to see that change in the near future, but we will see. I guess it'll be something that we can catch up on in some point in the future. But thank you so much for speaking with me today, Paula. This was a very illuminating conversation.
Kimberley, thank you so much for your time.
Thank you for listening to In Conversation With. We do hope that you enjoyed it. Please do keep up to date with all our new releases via Podbean, Apple Podcasts, Spotify, and everywhere else you get your podcasts from. You can also keep up to date with all our new content published on the Money Marketing website, as well as our print edition Money Marketing magazine. So make sure to subscribe. Follow us on Twitter, LinkedIn, Facebook, and Instagram. See you next time.